Welcome to Professor Abhijit Bakshi's Stockology Club. Today we are going to discuss a topic which is linked with our previous topic. So last week we have discussed about the US Treasury bond and its impact on Indian market. So some terminologies that we have used in that video that is not discussed in that video. All those terms are the terminologies we are going to discuss in today's video.
So let's start. So bond is a financial instrument, okay? So which represents debt. So where the issuer of the bond actually they are borrowing fund. Now let's take an example. Now this person he is representing the government, okay? So the government requires fund for building some national project or infrastructural project, okay? And right hand side the lady, Miss Capital, she is representing a company. She also requires some fund. Okay. Now, since they require fund, they will have to issue the bond for borrowing money. Okay. Now, this bond can be of three types. When it is issued by a company, okay, it will be called as a corporate bond or debenture. Next, when that bond will be issued by the government, it will be termed as the treasury bills or the gilt fund. Okay. And bonds that are of short term in nature, they are termed as the commercial paper or notes. Okay. Now, since the bond instrument, it is an agreement or it is a contract between the lender or the borrower or the investor. Say for example, the bond, it is the face value of that bond or the amount that is borrowing, the principal amount of that is say 1,000 rupees. Now, since it is borrowing, there should be some interest rate. Okay. So 8% is the interest. Okay. And the loan will be taken or the amount will be borrowed for a certain period of time. So here it is say 10 years. Okay. Now, let's try to understand the triangle. Some terms or terminology that we have discussed. So let's discuss the important terms or the terminologies that are associated with a bond. Okay. So at the core of a bond, there will be a face value. Okay. So this face value actually it is the principal amount that you are borrowing. So if you are borrowing say 1,000 rupees, so 1,000 rupees will be the face value of that bond. Okay. Now, so we have discussed about the interest rate. Okay. Interest rate or the interest that will be offered on that bond. So in bond parlance, the interest is called as a coupon. Okay. Now, another important term that is very important term in respect of the bond that is called the yield. So yield is nothing but the rate of return that you can expect from that bond. Okay. So which is completely different from the interest rate. So bond and this bond interest rate or the coupon rate and the yield, these two are completely different items. Okay. And third important item that is the market price. Okay. So since these bonds are traded in the market, there will be a market price. Okay. Which is different from the face value of that bond. Okay. So here lies the difference between the fixed deposit and the bond. So the fixed deposit, on the fixed deposit also you can get some interest rate. Okay. You can gain or you can earn some interest. But fixed deposit are not traded in the market. So there is no market price of the fixed deposit. But in case of bond, since it is a traded in the market, there will be a market price of that bond. Okay. Now, so since that interest is paid, so interest will be paid annually or quarterly or half yearly, whatever be the case. So if it is say annually, so 8% say if it is interest is given. Okay. So face value is 1,000 rupees. So 80 rupees interest will be paid for the whole tenure of the bond. So what is the cash flow or the earning from that bond? It is the 80 rupees fixed for each and every year. Okay. And on the last year, that is on the 10th year, along with this 80 rupees, you will get back the 1000 rupee principal amount. Okay, so in the last year, that is the 10th year, you will get 80 plus this 1000, that is 1080 rupees. Okay, so whatever you have lent, that 1000 rupees, that is repaid, and along with this, in this 10 years, you have got 80 years as interest in each and every year. Okay, now, so what is that yield? Yield of that bond. Okay, so yield, how is it calculated? It is calculated as the interest rate divided by that market price. So interest, we have discussed that each year you are getting 80 rupees. So if the market price of that bond, say for you have bought that bond at 992 rupees. So what is the rate of return you are getting from that bond? 80 divided by 992. That is 8.06. So here you can see the interest rate that is offered on that bond is 8%. But the rate of return or yield you are getting is 8.06%, which is different from the interest rate or the coupon rate. Now, why this yield is important? Because if it will be important, helpful for the investors to compare the different bonds. So if there are, say, 5 types of bonds are available with you, okay, so how to compare, how to select one bond out of these 5 bonds? You can take, you can consider this yield as a measure, okay, for which bond is giving me the better. So as an investor, you will look for the which bond is giving me the better or the best rate of return or the yield. You will go for that bond only. So when you are investing in bond or when you are trading on the bond, you should look after the yield, not on that interest rate that is offered or the coupon rate that is offered. Here lies the importance on the yield. In our previous video on that US Treasury bond, we have discussed a lot more times on this yield only. Okay, how is it related with the other aspects? So now let's see the what are the relationship among the different aspects related to the bond. Okay, so this relationship is very important, the relationship between the interest rate and the bond price. Now here you can see that the relationship is the opposite relationship, okay, or the negative relationship. That is, when the interest rate will rise, the bond price will fall, and vice versa. Why? Why is this so? Because when their interest rate is reducing, say RBI is thinking to reduce the interest rate, okay, so in that case, what will happen? The existing bond that you are holding, it is giving the better return or better interest rate rather than the other bonds, okay, or rather than the other bond means the bond which will be issued now. So the this current bond that you are holding, it will be much more attractive to the investors because it is giving, it is offering better interest rate. Okay, so therefore the demand for that bond will increase, therefore the price for that bond will also increase. Similarly, conversely, opposite, if the interest rate increases, then what will happen? If the interest rate increases, the bond price will fall. That means the current bond become unattractive to the investors because it is offering lower return. Okay, so therefore the demand will fall, therefore the bond price will also fall. So there is a negative relationship between the interest rate and the bond prices. Okay, now next important relationship is the inflation, how the inflation is affecting the yield. Okay, so when there is an increase in the inflation in the economy, so it is expected the regulatory bodies of that country, they will increase the interest rate. Okay, so it is expected that interest rate will increase. So if there is an increase in interest rate, what will happen? The current bond, it will be less attractive, so price will fall. So if the price fall, then what will impact? The yield will increase. So when there is expected that inflation will increase, then what will be the impact, possible impact on the bond? The yield will also increase. The same thing we have seen in the US Treasury bond that we have discussed in the previous week video. The link will be given below this video, that link of that video that is related to the US Treasury bond and what is the impact or what is the impact on the Indian market. So that video is given below. Okay. Another important aspect is the how the credit rating is affecting the bond prices. Okay. So you know there are different credit rating agencies. What is their job? Their job is to rate the different bonds. Okay. So what actually they rate? They rate actually the interest paying capacity, okay, of that organization or of that country. Okay. So if your repaying capacity, whatever financial commitment you have made, if that capacity, if the rating agencies think that the capacity of that organization of that country has reduced, they will downgrade the rating of that bond. So automatically the demand for that bond will fall and there will be fall in the demand price of that bond. Okay. So hope you will enjoy this video and this content what is delivered, it is important to you. If you think that is really important to you, and so motivate us to create more videos like this by sharing this video as well as subscribing to the channel. Thank you.